Hey Quants, today we're going to be going over a news article that I recently received that is intended to help you identify alpha. So it can be a common misconception that just because you have a good back test or you get some short-term good results that you think you have identified a trading strategy, but there are quantitative ways to help you identify if you have identified a good strategy. And this will be one of those ways that you can use that. It requires a lot more effort than some of the tools that we offer within Crown Quant Alchemy, in the sense that we give you a lot of tools that just allow you to plug in and do some testing and forward testing and then apply your strategies. That's definitely a more simplistic way to go. However, if you are curious and you want to get into some more complicated approaches on how to identify if you have alpha, this would be one way to do it. This article I received as a subscription to an email newsletter from PyQuant News. So if you are interested in receiving newsletters similar to this, then I would suggest you go over to PyQuant News, and it's just a website. They also have an X account, and you can provide an email address and subscribe and get the same information that I'm getting here. It's also probably an easier way to get access to this code, since this code is not something I intend to post anywhere, although it's not a ton of code, so you shouldn't have a problem just copying what you see on screen if that's your preference. So the purpose of this is to essentially create a factor that's going to tell us if a signal is likely to mean revert or not. And so we're going to go through some of the code, and we're going to basically validate that with the top stocks that we have now. And I'll go over those as we get to that. And with that factor, we can then determine if a stock, as I mentioned, will be mean reverting, or if it's more likely to be a momentum play. And so to set this up, generally you'll be using a Jupyter notebook. That's generally, you can use whatever you want, but a Jupyter notebook is a very easy way to do that. You can go online and just use a Jupyter notebook. A lot of times they'll have the libraries available for you, so you can just do that without having to install anything on your local system. Personally, I like to use the notebook extension in VS Code or cursors, and then I can just use the development environment that I enjoy using. So if you do that, then you do need to set up a Python environment. I'm not going to go through all the details of that, but the libraries that you need to install will be easier to, in my opinion, will be easier to install if you just create a requirements file, and then you copy the core libraries that you'll need, and then you can just use pip install -r and reference your requirements file. That'll go through and install all the dependencies that you need. Once you have that, then you can just use this as a Jupyter notebook, since that's what the extension does. It allows you to use this as a Jupyter notebook. And so I have imported all these libraries. This is, as I mentioned, code that I received in an email newsletter, and I just wanted to go through and kind of break down some of the details over a video and kind of present this information for other people that might not already have this information, but might want to be going a step farther in terms of like quantitative analysis and that. So I've imported this, and I've just executed this cell. I didn't receive any errors. The point of that is just say, hey, my environment's working and I have everything. So once we have that all working, the next thing that we want to do is we want to download some data. So as I mentioned, we're going to be doing this over a number of stocks. And the newsletter didn't include any crypto, but because I tend to do more crypto stuff, I wanted to include BTC and Ethereum. And so what we're going to do is we're going to come in and we're going to download that data from 2020 until the end of 2024. And clean that data up by just removing any NA values. And so that's effectively what this cell is doing. We remove the NA values in the later cell. So I'll just execute this just to show that it's working. And so the next thing that we're going to do is we're going to create a mean reversion for these values. So we're creating a factor to identify how far price has moved from the 22, essentially your 22 moving average, daily moving average. And So the idea is to see how far price has moved from its historical trend over that window. You can change later. We'll talk about this. You'll be able to change that window, which I had just changed it to 80 when I was playing around with it myself. But within the newsletter, it does reference using 22 days. And so the reason we reference 22 days is because that is essentially a monthly trading calendar, or a good estimate of a monthly trading calendar. So we're going to calculate the mean reversion for all of these stocks, which is Apple, Microsoft, Google, Meta, Nvidia, Amazon, Tesla, and then of course, as I mentioned, I'm including Bitcoin and Ethereum here. And so the whole point of this is to calculate that factor score. And so based on the factor score, what I'm trying to identify is essentially how unusual is that price movement for that stock. And if the price has moved too high, then it might be ready to pull back and effectively give us a mean reversion. Or on the other side, if the stock prices drop too low, we might expect it to increase. Again, identifying a mean reversion play. And so that is what we're trying to do. So we're going to go through and we're going to also run this over some different daily time frames so that we will have those for later processing if we want to use those. So moving forward. So after I've generated this data here, the end result is essentially a data frame that now has this factor score, right? So the factor score is the thing that I care about here, but I also wanted to highlight that we're also calculating the returns that we get on a 1 day, 5 day, 10 day, all the way up to 126 days, right? And so that way we can identify over different time frames if this would potentially work out as a mean reversion play or not. And so I'm just printing those values out here. I won't run that again. And so as an example, we can look at one of the stocks here. In this case, we're looking at Tesla to see, based on that 22-day target, what did the data look like? Did we see that this was looking, well, just to see how the data looked, right? So if I go ahead and I'm just going to run this again, it's going to produce this image here. And so as it mentions, right, this is each dot is just one moment in time. And so we'll see some outliers here based on that factor score. But what we really want to know with this particular factor score, so we have a high factor score. So the idea is like, okay, this is kind of an outlier. And what we want to know is that data, when we get that outlier signal, is it more likely to mean revert, or do we expect it to continue moving in the direction that it had been moving? So essentially a momentum play. And so to be able to test that, we're actually going to use this Spearman rank correlation. And so as we say here, a fancy name for a test that measures if two things move together or in opposite ways, which is effectively what we're trying to do, right? So we want to see if that factor score is really high, is the price going to turn around and move back down, or is it going to continue going? So that would be a mean reversion play, or do we expect this to be a momentum play? And so what we're going to do here is we're going to apply this to all of the stocks that we mentioned above, and we're going to calculate that statistic value, and then we're also going to calculate a p-value. And so what are we doing with these two values? Well, the statistic value is going to tell us if the statistics value is a positive number, then is that more likely to be it's more likely to be a momentum play. If it's a negative value, then it's more likely to be a mean reversion play. And then the p-value tells us if there's statistical significance in that statistic value that we just tracked there. And so what I mean by that, just looking at this chart here, is Meta, we would expect that to have a high statistical significance because the value is effectively 0 here. If we're looking at something like Apple, this statistic factor that we calculated does not have a high statistical significance. And so this is where the email thread had stopped. It actually didn't even print out these values, which is not that big of a deal. It doesn't really take that long to come in here and put in the code. If you have the email newsletter, you can basically just copy and paste that information and put it in here. But from my perspective, what I wanted to know, without going line by line, which you can do, to say, okay, well, this is more likely to be if we're looking at Meta, for example, this is more likely to be a momentum play, and it does have a high statistical significant value. So maybe I want to look at a momentum strategy when I'm looking at Meta. Now, keep in mind, this is also over a month window, effectively using that 22-day rolling window. So if you're looking at monthly strategies, you might want to be looking at a momentum play there. However, if I'm looking at Google, for example, this is a negative value and it also has a high statistical significance. I might want to be looking at a mean reversion play if I'm planning on playing a monthly strategy on Google. And so in order to get a very simplistic view of this without having to go line by line, it's not a lot, but if you add more, if you want to add more tickers here, or you want to change out your windows, I did add just a kind of a conclusion or conclusive post here, and this just lays it out a little bit easier. And so I think I ran that other one, so hopefully this should run. It looks like I did not run this one first, so I'm just going to run this, and now I have the data in memory, and I'm going to run this. And so basically this is what we're seeing here. So the top positions, these are momentum-like strategies. And so they are statistically significant. And what I'm identifying as statistically significant here is I'm filtering out some of these values if they don't have a value of 0.05. So and that, what I mean by that is if I'm looking at this statistic and this statistic isn't greater than 0.05, that factor score, I'm not even going to bother looking at it. And so that automatically, in this case, filters out Nvidia and Apple. Now, having looked at stocks myself, and I do that fairly regularly, I am not that surprised that Apple would get filtered out of this list. However, I was quite surprised that Nvidia would be filtered out of this list, because I would have expected Nvidia to fall fairly strongly with significance on a momentum-like play, which we're not seeing here. And so again, this is just the statistics, it's the data. You don't have to agree with it, but if you would like to play with this some more, you could definitely change your rolling window if you want to try and play shorter time frames, or identify potentially mean reverting strategies on shorter time frames, or if you wanted to identify mean reversion on longer time frames. I don't know who's going to play longer than a monthly time frame. If you're interested in trading, even if you're doing some long-term investments, a monthly time frame is fairly long, but you could definitely obviously go longer. You could take this code and run with this. So basic results here: Meta, Ethereum, and BTC. And I'm just doing like a gut check here with my own experience, having since I look at the market on a daily basis. All those are being classified as momentum-like. However, the Google, Microsoft, and Amazon are looking like they would be better if you wanted to utilize a mean reversion play. So again, one of the benefits here of using statistics is some of this actually is counterintuitive from what I would have expected from my own experience with analyzing the market. I would have now I haven't looked at Microsoft recently, but I do recall Microsoft was moving up. To be fair, all of these stocks were moving up quite regularly, but over a longer period of time, it looks like it might make more sense to do a mean reversion play versus just a trend following strategy with something like Microsoft or Amazon or Google even. However, BTC, Ethereum, and Meta, those also, in my opinion, are momentum-like strategies. And so all that said, this can invalidate some of your ideas, but if that's the case, then maybe you just need to continue to dig deeper. So I hope you guys found this interesting. If you do want to get some more content like this, I might end up doing some more videos where I cover some of the information that I get and try to provide a little bit more on top of that. But it's PyQuant News if you want to go and subscribe to their newsletter. And I hope that you guys learned something new. Peace, Quants.